I think the entire digital assets economy is exploding and growing in a bunch of different dimensions. Right now, the way to think of it is that half of the economy is built around Bitcoin. It's digital capital. Bitcoin is digital gold. And the killer application on top of digital capital is digital credit. Instruments like Stretch, STRC, credit instruments that pay yield.
And it can help the smallest and the lowest demographic. If you can just put away any money and you can buy a fraction, 1/100 millionth of a Bitcoin to start, it's just, there's something there for you to buy that cannot be debased. And that's why we did this, is that we really believe in this system and in Bitcoin in the future. So
Bitcoin is stabilizing around $95,600 after a sharp 20% pullback from its $126,000 early October peak. The correction, fueled by $1.5 billion in ETF outflows and a slide into extreme fear on the sentiment index, has put traders to the test. All eyes are now on the crucial $94,000, $92,000 support zone, which aligns with key Fibonacci levels and major moving averages. A breakdown could spark a deeper drop, but if this range holds, analysts expect a rebound toward $110,200 in November and possibly $128,000, $135,000 by year-end, depending on renewed institutional inflows. Despite the volatility, the broader bullish outlook hasn't changed. Bitcoin's long-term momentum continues to be driven by the institutional supercycle, with corporate treasuries and spot ETFs now holding millions of coins and reinforcing Bitcoin's position as a leading macro asset. Analysts like Michael Saylor and James Lavish argue that Bitcoin's fixed supply and store of value design make it the ideal hedge against fiat debasement. For now, the market appears to be shaking out leverage before the next major macro-driven move. Let's take you back to the interview to hear Michael Saylor's latest price prediction.
Hey, I am Maria with DailyDoseCrypto. Have you noticed that gold, silver, and Bitcoin have hit all-time highs recently? Is this a coincidence, or are smart investors onto something? The dollar is depreciating, inflation is eating up all of our cash, and the US national debt is through the roof, hitting new highs every day. That's why people are shifting to alternative assets like gold, silver, and Bitcoin. We at DailyDoseCrypto have partnered with ITrust Capital, your one-stop platform to buy and securely store 80+ digital assets, including Bitcoin, gold, and silver to hedge your future against debasement. With over 200,000 accounts, 15 billion in transactions, and 11,000 plus positive reviews, they're helping real investors build long-term wealth with their tax advantage, IRA, and PCA, which is a premium custody account that supports the highest level of custody and security in the space. They do this all with institutional-grade custody through partners like Fidelity Digital, Fireblocks, and Coinbase Prime, keeping your assets secure while you can trade 24/7. Fees are just 1% per transactions with no monthly or annual costs. Getting started is simple. Sign up for free and fund an IRA or PCA today. You'll receive a $100 bonus and start growing your assets the smart way. Click the link below to open your account now and begin your journey toward generational wealth.
I think we all want to go to the moon, but if you want to ride the rocket, you got to be prepared to pull the G's. Over 5 years, Bitcoin's had like 6 brutal drawdowns. If you roll the clock back 13 months, we were sitting around 68,000. And then after the Trump election, we had this incredible rally from 68 to 106,000 in 5 weeks. If you go back 14 months, we were about 55,000. And so if you'd said we're going to go from 55,000 to 94,000 in 14 months, that would have exceeded any reasonable investor's expectations. Over 5 years, Bitcoin's up about 50% a year on average for the 5 years. Gold and S&P are studying the cost of capital to 14%. My company's strategy is up 71%, equivalent to NVIDIA. There's no other stock in the S&P that's done any better. So I think the volatility comes with the territory. If you're going to be a Bitcoin investor, you need a 4-year time horizon, and you need to be prepared to handle the volatility in this market.
So when you look at the price right now, and then we'll talk about the implications for strategy, but when you look at the price right now, what does the upside at this moment look like to you, and what does the downside in this moment look like to you?
I feel like we put in a pretty strong base of support around here. There's an incredible amount of leverage coming out of the system, a lot of liquidation. a lot of the OG holders were selling at the $100,000 level, and so I'm fairly comfortable at this level. I would think that we'll build from this base and we'll rally from here. Obviously, it's hard to make a forecast for the end of the year right now, given what's happened over the past few weeks, and especially the shift in the macro environment. But, as you know, my view is Bitcoin's going to outperform gold. It's going to outperform the S&P. It is digital capital. And so if you're a long-term investor, this is the place to be. Well, I mean, it's pretty important to note that we're not even 1.15 times levered. We're very fractionally levered, and our debt that we have is 4.5 years out. So we don't really have any trigger points anytime soon. And if Bitcoin were to fall 80%, we're still over collateralized and we're fine. So our balance sheet's pretty stable. The company's strategy, just like an intelligent bank, would be to build amplification for the common stock using preferred equity. So the equity never comes due. It's a dividend payment declared by the board. It's not a coupon. We can't be in a default. There is no credit default situation from the digital credit that we're selling at this point. I think the entire digital assets economy is exploding and growing in a bunch of different dimensions. Right now, the way to think of it is that half of the economy is built around Bitcoin. It's digital capital. Bitcoin is digital gold. And the killer application on top of digital capital is digital credit. Instruments like Stretch, STRC, credit instruments that pay yield. And that's a very simple business. The other half of the economy is digital finance. And it's going to be built on the proof of stake networks that are emerging, the Ethereum Solanas, the BNBs. And the killer application for that part of the digital assets economy is tokenized currencies, a la stablecoins, tokenized securities, tokenized real-world assets, tokenized brands, and DeFi in general. Well, that's a very complicated technical development, and I'm sure that stablecoins are going to go from hundreds of billions to trillions of dollars. But it's not really competing with digital capital. No rich person wants to buy the currency instead of an equity or a real estate or a capital asset.
Michael, given where Bitcoin's trading right now, are you buying?
We are buying. We're buying quite a lot, actually, and we'll actually report our next buys on Monday morning. I think people will be pleasantly surprised. In fact, we've been accelerating our purchases.
Are you ever not buying, Michael?
No, we're always buying. Bitcoin's always a good investment.
But no, that's interesting, though, in terms of buying today at $95,364 versus buying 2 or 3 weeks ago. You're saying you were buying it at both. If you were to look over the last year, sort of at your average, do you weight the buying based on trading?
We now own nearly 3.1% of the network, and we bought it on a blended average about $74,000 a coin. The point that I would make for any investor is, if you have money you don't need for 4 years or longer, and if you don't trust anybody, you want no counterparties, you just want to own a piece of the global digital economy, you buy Bitcoin. It's the commodity. If you're an equity investor and you want to bet on digital credit and you want to bet on digital capital and you want some amplification, you buy an equity like MSTR. Right. If you have money for less than 4 years and you're an investor and your time frame is 12 weeks, you should buy the digital credit. For example, the credit instruments we've created have stripped the volatility off of Bitcoin. Bitcoin's vol is like 45 on a trailing 30-day average.
Bitcoin has seen heavy volatility over the past 5 years, including 6 major downturns. Just 14 months ago it was trading near $55,000, then surged more than $16,000 in 5 weeks following the Trump election, far exceeding most expectations. Historically, Bitcoin has averaged about 50% annual growth, compared to roughly 14% for gold and the S&P 500. This level of volatility is normal for Bitcoin and is why experts recommend at least a 4-year investment horizon. Right now, the market appears structurally strong. Many long-term holders sold near the $100,000 level, helping reduce leverage and lowering liquidation risk. Bitcoin exposure today is generally lightly levered, with stable balance sheets designed to withstand large price drop. Meanwhile, the broader digital finance space, stablecoins, tokenized assets, and DeFi, is expanding fast but serves a different purpose than Bitcoin's role as digital capital. Most long-term investors focus on consistent accumulation, buying at different price points to smooth volatility and capture long-term upside. This strategy reflects confidence that Bitcoin will continue outperforming traditional assets over time. Now, let's return to James Lavish for his take on the current market environment.
And now you've got the Fed battling these two different mandates. They've got the stable pricing and they've got the full employment. We don't know what full employment is. It's just a kind of the, check the temperature of the country. Let's see where it is. But, it's what they're really afraid of, what everybody's concerned about is, are we entering a period of stagflation where prices continue to rise and the economy rolls over? So that's kind of been on everybody's mind. And right as all that happens and the Fed comes into the fall and lowers rates, we have a government shutdown. So that government shutdown has now kind of taken liquidity out of the markets. What happens is the Treasury continues to issue debt and draw money out of the markets, draw it out of reserves, bank reserves. And, they can't spend it. It just goes into their checking account. It sits there. So that's kind of been this overarching issue that people have been watching and wondering when it's going to be resolved. Apparently, it's going to be resolved today with the House meeting. We'll see. The Senate has already passed a continuing resolution to get the government up and running again. But, and apparently that the House is going to follow suit, but you never know. So I'll believe it when I see it in the headlines and it's actually done. But that's kind of just big picture what's been going on. At the same time, you had the markets rip to all-time highs and kind of stay there. And you've had gold rip to all-time highs and back off a little bit, but it has been strong. It continues to be strong. Mm-hmm. And that tells you that there's a few things going on. It's trading at about $4,200 per ounce today. And that's telling you a number of things about not just the economy, but about foreign central banks and foreign entities, what they want to own. And is it U.S. Treasuries? Is that the global reserve asset, or are they starting to turn to gold? And how much of that gold pricing has to do with uncertainty in the markets of everything I just talked about? And so lower rates and continued deficits, which is what we get back to on, this fiscal driven economy that we live in. And so that's kind of the worry there, is that you've got this K-shaped recovery where, if you look at the consumer and you look at actually the two different demographics, and I posted about this recently, and I'll bring up the posters so you can see it, but the two different demographics and just how stark a difference it's been for the wealthiest demographic versus the less wealthy. And here's the net wealth of the top 1% since 1990 versus the bottom 50%. You'd say, well, bottom 50% hasn't done that bad. Look at how big this white space is here compared to this way. It's done actually pretty well. But remember, this is the top 1%. Okay. Mm-hmm. So when you do out the math, the top 1%, here are the metrics. So per capita, the top 1% per person went from $1.8 million of net wealth to $15.5 million for a $13.6 million gain. That's an 8x multiple. The bottom 50%, remember, they're sharing all of that, right? They're sharing all the bottom 50% you have 50% of people sharing this. So according to the demographics and the census from back in 1990, the bottom 50% on average had $5,700. By the end of 2025, they had $25,000 for a $19,000 gain. So they made 4x. They've gained 4x in wealth, half of what the top 1% did. So it's just getting worse. And that's really the concern here, is that we've got this, separation of wealth that's occurring because of the way that our economy is driven, and the debt-driven economy, that if you don't own assets, that you're being left behind, which gets all the way back to everything that we talk about every day and preach on owning gold, owning Bitcoin. I prefer Bitcoin, long-term. And this is what I write about in the Informationist every week, is just how and why you should be owning assets, and explaining in different, all the different things that are going on in the economy for people to understand that. And it's why we launched the Bitcoin Opportunity Fund. David Foley, my partner, and we are extremely confident. I have super high conviction in Bitcoin as an asset and as a base layer for an economy that we need. And it can help the smallest and the lowest demographic. If you can just put away any money and you can buy a fraction, 1/100 millionth of a Bitcoin to start, it's just, there's something there for you to buy that cannot be debased. And that's why we did this, is that we really believe in this system and in Bitcoin in the future. So one of the things that confuses people is that, I ask any of your normal friends that are not neck deep in this stuff and talk about inflation. I do it all the time. I say, well, what do you think inflation should be? Like, what should the inflation rate be? And they say, well, I think it's about like 2%. That's good. And it makes you, because if you don't have 2%, then people will hoard their money, and then it'll grind the economy to a halt because they won't spend and buy things. And they've been brainwashed into really, truly believing that inflation is normal, and not understanding that with technology, we should have deflation. We should be getting everything for less. Some people talk about it matches the rate that of gold extraction, but really, the best explanation I've studied or heard is that the New Zealand bank came out with it in the 90s, and everybody just gravitated to it. Now, why would it be 2%? It's a good question. If inflation is 5%, you're going to feel that, because in just 2 years, your spending, your purchasing power is down by 10% if your wage hasn't kept up. So in 5 years, it's down 25%. Everybody felt it in COVID. The official reading for inflation during COVID is that from 2020 to 2025, you lost 25% of your purchasing power. Now, you and I know that that's probably understated.
Wait, can you repeat that one more time? How much purchasing power have we lost?
From 2020 to 2025, you lost 25% of your purchasing power. That's how much inflation it was.
Yeah.
And that's the official number. So now think about it. Let's go back to first principles. Why do we have inflation? Well, we should have deflation.
James Lavish explained that the Federal Reserve is struggling to balance its dual mandate: stable prices and full employment. Full employment isn't a precise metric, and the real worry is whether the U.S. is sliding towards stagflation, rising prices combined with slowing growth. Recent events haven't helped. The government shutdown temporarily drained liquidity because the Treasury kept issuing debt but couldn't spend it, reducing bank reserve. Although the Senate passed a funding bill, House approval was still uncertain. At the same time, markets were hitting record highs and gold was nearing all-time levels, reflecting global uncertainty and the possibility that foreign central banks may be shifting reserves from U.S. Treasuries to gold. Lavish also highlighted that the economy is heavily fiscally driven, with persistent deficits and low rates contributing to a widening wealth gap. Since 1990, the top 1% have grown their wealth eightfold, while the bottom 50% have only seen a fourfold increase. This rising inequality strengthens the case for owning assets like gold and Bitcoin as long-term protection. He also pointed out that many people accept 2% inflation as normal, even though technology should be driving prices down. Official data shows a 25% loss in purchasing power from 2020 to 2025, underscoring why holding strong assets matters. So as we close, the question becomes, which asset better preserves long-term value: Bitcoin, with its digital, divisible, decentralized structure, or gold, with its physical stability and centuries-long safe haven reputation? Share your thoughts in the comments. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.